Management CIO Erin Gibbs. Erin, I know you were listening to all of that. Yet we have this, I know Main Street and Wall Street are different, but for Wall Street, I mean, it's so bullish out there. There's an RBC indicator out now, and they say they see the S&P 500 ending this year at 5,300, which honestly, Erin, isn't far from where we are now, but they increased that from 5,150. They're not the only ones. I mean, if everybody's so bullish, is that time to be cautious?
I think so. And in part, a lot of the bullish comments are belief that the Fed will cut rates 3 times this year.
Do you believe that?
I don't think so. I think looking historically, we already are seeing, just as you mentioned, the core going up. We've also seen 2 months of PPI and basically the producer side, the wholesale, the commodities going up. And when you have a tight labor market plus inflation, and we're seeing early signs of reinflation, you often have a second spike. And we saw that in the 60s, the 70s, the early 80s, we saw that in the aughts. Rarely do we just get one spike of inflation, we frequently get 2. And so the fact that the Fed says that they're going to be cutting rates consistently over the next 3 years really ignores the likelihood of a potential second spike. And so I think that's where the disconnect is, as Wall Street really thinks it's over, we're done, inflation, it's a one spike time, we're just going to see rate cuts go down. And if that's a mistake, Wall Street's going to be pulling back.
Are we in that second spike right now?
Right now, we're basically flat. We're sort of hovering between, depending on which index you're looking at, we're very flat. But what is concerning is that we're seeing starts of spikes on the producer side, so your commodity side.
So that was my question. What exactly is costing more money? I want to say everything, because that's how it feels when we go shopping or book a flight or whatever it is we're doing. But what exactly is...
So for the past 2 months, about half of all commodities out there have really spiked. And I know we like to talk about cocoa and the price of chocolate. Later. And yeah, because that is important, especially for Easter. But other things like your industrial metals, those type of things.
Your raw materials.
Your raw materials. And that takes, those are sort of like your early warning signs, because it takes a little while longer to get into it. And also, look, actual goods are only 1/3 of our economy. The other part of it is a very stickiness of inflation within the services side. And that's the other 2/3 of our economy. And that we're also seeing is something that companies aren't able to are transferring higher prices because they have to pay employees more.
There's a lot of euphoria out there. So if you're an investor and you're watching now and we're listening to you and you're saying that potentially this second wave of inflation is here, how do you trade it?
So one of the ways is stick to your safety stocks, so your large caps over your small. Your small and mids are the ones that are going to get hit the hardest if the Fed does change their tune.
Meaning if they don't cut,
if they say, oh, if it's only going to be 2 cuts instead of 3, it's only going to be 1 cut. The small and mid caps are going to be your absolute hardest hits.
Would the Fed hike, in your opinion? Is that a possibility in 2024?
Not in 24.
Okay.
Not in 24, because I think to really get that spike, it takes them 9 months to do anything. Like, we'll have 9 months of inflation before they raise rates. So this is definitely a 2025 issue. But I would say I'd be prepared to be defensive, have those backup plans ready to go. And energy right now is just an easy play, because that's just been continued to go up.
Is energy performing better than technology?
Yes, it is. It is the best performing sector year to date. So
is there AI in energy? I'm sure there is, but it's not something we talk about.
Not something you talk about.
Erin Gibbs, thank you very much.
You're welcome.
And